After last week's news flow bonanza, when a quarter of the FTSE 100's members released figures and 3 major central banks unveiled interest rate decisions, it's a little quieter in the week ahead, though I admit, not by much. Inflation figures from China and America will be the main focus from a top-down perspective, and they're due out on the 9th and 10th of August respectively. By way of a benchmark, consumer price inflation, or CPI, in China was 1.7% in June, while it was 2.9% in the States. And that was America's highest rate in over 7 years, which may be why the US Federal Reserve continues to nudge interest rates slowly higher. On the corporate front, around a dozen FTSE 100 firms are set to release interim or full year results, with a good few FTSE 250 companies also updating their shareholders. Names to note include Intercontinental Hotels, Intertek and Standard Life Aberdeen on Tuesday the 7th of August, Glencore, Prudential, Paddy Power, Betfair and house builder Bellway on the 8th, and Legal & General and Randgold Resources on Thursday the 9th. Now, even allowing for that lengthy list, my guess is that the company most likely to cause the biggest fuss in the week ahead will be megabank HSBC, which is set to release first half results on Monday the 6th of August. Now, as we can see here, the shares are down for the year to date and even below where they were 12 months ago, despite producing some decent earnings figures in the meantime, churning out a share buyback programme and offering reassurance on its meaty dividend. Now, it must be said that HSBC is far from unique in this respect. The FTSE all-share banking sector has done badly, with a 6% fall to date this year, a figure which makes it only the 32nd best performer out of the 39 groupings which make up the FTSE all-share. Banking stocks have been similarly uninspiring performers worldwide in the US, Europe and Japan this year. Quite why? Well, that's hard to tell, but it may suggest that someone somewhere is either worried about the global economy, the state of the globe's financial plumbing, ongoing increases in global indebtedness, or something else. Whatever it is, this makes HSBC's interim update particularly timely. Analysts will initially focus on the headline pre-tax profit number. A year ago, this came to $10.2 billion, so that's your benchmark for the first half of this year. The next graphic shows the quarterly progression over the last 5 years. Analysts and investors will then move on from the quantity of profit to the quality. The first number to check here will be the growth in risk-weighted assets, and then a quick look at growth in loans. Under Stuart Gulliver, HSBC's focus was simplifying the business, cutting costs and improving its conduct in the eyes of the regulator. Mr. Gulliver stepped down after 7 years in the job in February, and his successor, John Flint, well, he may well be pressing the button on growth. Costs rose sharply in the first quarter of this year as HSBC began to invest in several initiatives, including greater digitisation, while risk-weighted assets grew 4% and loans 12% year on year, a marked change from the Gulliver era when the HSBC Bank was still shrinking itself back to health. After those figures, move on to loan loss and impairment charges, restructuring costs, and also those dreaded litigation and conduct provisions that relate to things like protection payment insurance, or PPI. All of those items have weighed heavily on HSBC's profits for the past several years, as we can see here on a quarter-by-quarter basis. In fact, the total cost since 2013 has been some £26 billion at HSBC, compared to pre-tax income over the same period of £73 billion. If these numbers drop, then earnings can rise sharply, although the 2019 deadline for PPI claims in the UK mean there's always the risk of a final surge in costs here. This next chart shows how all three have added up on a quarterly basis, also back to 2013. Now, after looking at the profits, attention will switch to dividends and share buybacks. In 2017, HSBC bought back $5.5 billion worth of its shares, and it topped that up with the announcement of a further $2 billion alongside the full year numbers in February, although that had been lower than some analysts had hoped for, so watch for any comments here. As for the dividend, well, the bank's paid 51 US cents a share on an annual basis since 2015. That's been formed of 10-cent payouts for Q1, Q2 and Q3, before a 21-cent distribution for the fourth period. If this is matched in 2018, and that's what analysts expect, then that would equate to a dividend yield of around 5.4% on a 7.24 share price and using an exchange rate of $1.31 to the pound. Thank you for watching, and I look forward to seeing you next time.